Any housing purchase in Bakersfield comes with several decisions, and one of the most important you'll make is on the type of financing you use to buy your dream home. There are many home loan financing programs available, with various terms of repayment. In this article, we will focus on the fixed-rate mortgage. A fixed-rate mortgage is a mortgage that will be completely paid off over the specified period of time, usually 15, 20, or 30 years, assuming the homeowner makes all the payments as scheduled. With a fixed-rate loan, the interest rate remains the same for the entire span of the mortgage. Your mortgage includes several components. Learning about each one can help you better estimate the total cost of your potential monthly payments. A helpful acronym to remember is PITI-MI: principal, interest, taxes, insurance, and possibly mortgage insurance. The principal is the original amount you borrow from a lender to purchase your home. For example, if you buy a $500,000 home, make a 20% down payment of $100,000 and borrow the remaining amount, your principal would be $400,000. Interest. This is the fee the lender charges for letting you borrow money. Lenders calculate mortgage interest as a percentage of your principal. Property taxes. In California, the base tax rate is 1% plus any additional local taxes, usually for infrastructure or public safety. Home insurance. Most lenders require a home insurance policy as a term of the loan. Private mortgage insurance, PMI. You can avoid paying for private mortgage insurance by making a down payment of at least 20%, but this down payment won't waive mortgage insurance on an FHA loan. Mortgage insurance costs can depend on a few factors, including your loan type, loan amount, credit score, and down payment, although not all factors apply to all mortgages. The interest rates on mortgages change frequently. A few factors influencing those changes include the federal funds rate. The Federal Reserve decides the federal funds rate, which is the rate financial institutions pay to borrow money. The financial markets. When financial markets are down, mortgage rates tend to be lower. The opposite is also true. When financial markets are up, especially if there's a rise in inflation, rates tend to jump. Don't panic if interest rates increase in the time between when you start looking for a house and when you contact a lender. A slightly higher rate won't significantly impact your monthly payments. You'll also want to consider the other terms and services a lender offers. You might find a lender that offers a relatively low rate, but that doesn't provide enough support or other favorable terms. Several types of home loans may be available to you, and each comes with pros and cons. Finding the right type of financing will help you better afford the home you want. Here are some types of mortgages you might consider. The most common types of mortgage programs. As mentioned earlier, there are several mortgage programs available with various qualification requirements, terms, and conditions. Here is a brief description of the most common programs. Conventional mortgage conventional loans are split into two categories: conforming and non-conforming loans. Conforming loans meet the regulations for sale to Freddie Mac or Fannie Mae. Non-conforming loans, on the other hand, don't satisfy these guidelines. The primary difference between conforming and non-conforming loans is the principal amount of the loan, known as conforming loan limits. In Kern County, the conforming loan limit in 2025 is $802,650. In Los Angeles County, along with other high-cost areas, the limit is $1,203,975. Because of the diversity of rules, conventional loans don't have a set list of qualification requirements. However, they usually have stricter rules than government-backed loans, such as FHA loans. Typically, you need a minimum credit score of 620 and a debt-to-income ratio of 50% or lower. FHA mortgage. The Federal Housing Administration, which works under the Department of Housing and Urban Development, CHUD, guarantees FHA loans. So, the FHA protects the owners of your mortgage in case you default on the loan. With some lenders, you can qualify for an FHA loan with a down payment as small as 3.5% and a credit score as low as 580. Your lender may also want evidence of steady employment and a debt-to-income ratio below 50%. While FHA loans tend to be fairly accessible, you'll have to pay a mortgage insurance premium, MIP, if you finance your home purchase with an FHA mortgage. VA mortgage. A VA loan is backed by the Department of Veterans Affairs, VA, so it poses less risk to mortgage investors. You'll need a VA Certificate of Eligibility, COE, proving you qualify though. Active duty military members, veterans, surviving military spouses, and members of the National Guard and Army Reserve are all eligible if they meet certain requirements. VA loans have generally lenient borrowing terms, including credit requirements, low interest rates, and no minimum down payment requirement. Borrowers also don't have to pay mortgage insurance. However, keep in mind that VA terms and rates vary among lenders. Jumbo mortgage non-conforming loans. Jumbo mortgages are non-conforming loans, meaning they can exceed the conforming loan limits set by the Federal Housing Finance Agency, FHFA, and not conform to the guidelines of Fannie Mae and Freddie Mac. A conforming 30-year fixed mortgage can only offer a loan amount within the conforming loan limits. A 30-year fixed jumbo loan, however, can offer you more money if you're able to qualify. Before approving a jumbo loan, a lender may require a home buyer to have additional cash reserves. Advantages of a 30-year fixed-rate mortgage. Home buyers tend to prefer 30-year fixed-rate mortgages. Here are some of the advantages they provide. Lower monthly payments. A 30-year mortgage spreads out the cost of your home over the 30-year term, giving you additional time to pay the loan back. As a result, you make a lower monthly payment than you would with a 15-year or 20-year mortgage for the same property. Flexibility. Some lenders allow you to make extra principal-only payments every month, helping you save money in the long run by reducing the amount you pay in interest. Not every lender handles extra payments the same, however, so it's possible you could be subject to a penalty if you end up paying off your mortgage early. The ability to afford a more expensive home. When you choose a 30-year term loan, you may be able to purchase a more expensive home since spreading your mortgage payments out over the maximum number of years affects your debt-to-income ratio. For example, a lender may allow someone with a 15-year term to borrow $140,000, but someone borrowing on a 30-year term may be able to borrow $300,000. This is because with a 30-year loan, a smaller portion of your monthly income has to go toward paying your mortgage. Disadvantages of a 30-year fixed-rate mortgage. A 30-year fixed-rate mortgage promises some advantages for homeowners, but this loan might not be the best choice for everyone. Consider the following drawbacks. Paying more in interest. A 30-year mortgage will likely come with a higher interest rate than a shorter-term loan. That's because it takes longer for a lender to be reimbursed the loan. Lenders charge a slightly higher interest rate to help minimize any potential loss from unexpected inflation during the loan term. Needing longer to pay off the loan. A 30-year mortgage is the longest mortgage term that most lenders offer. That draws out your repayment period, meaning you'll pay more in interest than you would with a shorter loan term. Needing longer to build equity, which is your home's value, minus the money you still owe your lender. Which mortgage program is right for you? The answer to that question depends on you, your current financial situation, along with your long-term goals and objectives, both financially and personally. This article is for informational purposes only and should not be considered as financial, legal, or tax advice. Please consult with appropriate professionals regarding your specific situation.